Two people get divorced after 30 years of marriage. They decide to keep it easy and simple. They split all the assets in half. She keeps the house, he gets the 401k. And on paper, that seems equal. If we fast forward 5 years, she's selling the house because she wanted to move out, and she has to write a check to the IRS that she never really expected. He rolled his 401k into an IRA, and it has grown untouched. Remember, that was a same equal split with completely different outcome. When you divide assets in a divorce, equal and equitable are not the same thing. And if you're a woman over 50, that gap in retirement can cost you over six figures. Divorce after age 50 has doubled since 1990, and it actually makes up almost a third of all divorces in the United States today. But I think one number that's actually more interesting should stop you cold here. It's that women's standard of living after a divorce like this drops by 45%, while men's only drops by 21%. So think about those numbers for a moment. Men's standard of living is dropping by less than half of what women's do after a divorce like this. A huge part of this gap has nothing to do with the size of the settlement. It's the hidden tax and liquidity traps that are attached to all of these different account types. It's those little parts that would never show up when you're just dividing things in half. So today I'm walking you through those places where an equal split is not so equal, and exactly what to check and what to ask for before you agree to anything. There are a few in here that even financially savvy people miss, so make sure to watch to the end. Quick intro if we haven't met yet. I'm Jake Landau. I'm a fee-only fiduciary certified financial planner, and I help people just like you retire with clarity and confidence. The fee-only fiduciary, by the way, means that I don't sell any products like annuities or life insurance. I'm legally obligated to do what's in your best interest. With that, I also want to say that this video specifically is for educational purposes only. It is not tax or legal advice. Okay, so the question that I get most often with people going through this scenario is, we split the retirement accounts in half. That seems pretty fair, right? And the answer to that needs to be, what is the after-tax value of these accounts? Because a $500,000 account of a traditional or rollover IRA is not the same, and it is not equal to $500,000 in a Roth. Again, the same balance is not the same value for you. This especially matters if you're on the younger end of 50 rather than getting divorced in your 60s or 70s. Now, just to set the stage and for all of us to be clear here, traditional accounts or rollover IRAs as well, they are pre-tax money. So you have been contributing to these accounts by paying into them and not paying tax on those dollars. Roth accounts are the opposite. You have used after-tax money to contribute to those accounts. Now, the tax benefits to each of these is a little bit different as well. When you take money out of a traditional IRA, it generally counts as taxable income to you, while for a Roth, all of those earnings are grown tax-free. So traditional, you can think about this as not taxed on the way in, but taxed on the way out. And for Roth, those are taxed on the way in, but not the way out. So if you have split a retirement account and say you get the traditional IRA that's worth $1 million and your spouse gets the Roth IRA worth $1 million, that is not the same. If we use the after-tax value for that and you've taken the traditional IRA on a 22% tax bracket, you are now looking at $780,000, while your spouse gets to keep that million, and if they take it out, it stays as $1 million. They are not taxed on those withdrawals. So the rule here that you should really be following is that you are splitting by after-tax value and not the current balance of the accounts. The second thing that I see most often is that at least one of you is likely going to want to keep the home or the property that you've lived in. Maybe you've been there for a long time, maybe your children grew up there. Are you making a mistake by keeping the property rather than an account? Now, the answer to this can sometimes be more art than science, mostly because I need to validate first and foremost that it is a legitimate feeling to want to keep staying and keep living in a home that you have lived in for a long time, even if it is a financially bad or worse decision than selling it or splitting the property's value. Now, the biggest thing to consider here is that if you ever go to sell the home and you need cash, first of all, it is an illiquid asset, meaning that if you need cash down the road, you need to sell your home or find a way to get money out of it to be able to pay your expenses. That is difficult in itself. The other piece that is potentially working against you, if you are the one that is keeping the property, when you are married filing joint, you generally have a $500,000 shield on capital gains when you sell a primary property. If you are filing single, that compresses to $250,000. So just as a very easy example, say you and your spouse bought a home in the year 2000, for $500,000. If you were to sell that home today for, call it $1 million, and you were married filing jointly, that $500,000 gain is shielded from taxes. If you go to sell that later in the future and you are filing single, your shield is only $250,000. So you are now paying additional taxes on $250,000. So you really don't want to end up in a situation where you are house rich and cash poor. Please consider the tax bill that might be stapled onto it if you are filing single versus married filing joint. All right, the third thing that I see the most often, and again, it's something that you need to know about before this happens because you will really only get one chance of it. And the trap is essentially how you touch your retirement money when you split the assets. Your divorce decree is not enough for a plan administrator to know and understand how you want your assets sent and split among you. Now, the part that's good news, if you knew about these, is that a QDRO allows you to take money out of that retirement account. Now, here's the actual good news if you know about QDROs. It allows you to take money out of these 401ks and 403bs without a penalty if you are under 59 and a half. Under a QDRO, the penalty is waived. Now, a lot of people will just leave some of this stuff up to their attorneys and work it out. And for some of you that I'm sure will work out great, what I want you to consider is that attorneys are working on legal split, not the after-tax outcome. Those are really different jobs, and what I would encourage you to do is think about building a team of your attorney who is handling the divorce proceedings, a certified financial planner like myself who is helping you think about and plan for these things and draw up a plan for what those first few years look like, and maybe a CPA to help evaluate the taxable situation. This is exactly where people get hurt and wish they would have known before they did something. And that's why you want a team around you that has done this before. The last place I want to talk about today is something that you would think more people would consider, but I actually find that it gets missed a lot, is that your income is likely going to stay the same. You're going to keep your job, you're going to keep doing whatever you do to make money, but your income tax brackets are going to compress in half. When you are married filing jointly in 2026, your standard deduction is $32,200. When you are filing single, that gets cut in half as well to $16,100. All of those brackets compress and make it so that if you are earning the same amount, you might actually be taxed at a higher rate when you are filing single. So going back to the point on traditional IRAs versus Roth, this point actually gets more important to you now because keeping a Roth IRA with no income taxes might actually be more important after the divorce than before it. The rule here is that you really want to model out what your first few years are going to look like as a single filer, rather than what your life currently looks like married filing jointly. So if we just step back for a moment and think about divorce as a 50-50 split, when you consider taxes or the basis in the house, liquidity, or your new filing status, sometimes these splits are not equal or fair. And the hardest part about divorce is that the agreement is generally final. You can't go back and fix any of these things after they've happened. You usually only have one shot to get this right. This is exactly the type of work that I do with clients before they sign those agreements. We take your actual settlement options and we model them in a comprehensive financial plan to see what would be most beneficial and most fair for both of you. You can see what an equal split actually looks like and means for you, rather than just what is on a mediator spreadsheet. If you're facing a divorce later in life, or you can see one coming, I offer a flat fee comprehensive financial planning engagement. Again, I'm a fiduciary, so I'm not selling you any products. It's really built around your numbers and what your financial situation looks like. There's a link down below in the description if you want to book a call with me. And do me a favor, out of these traps, tell me in the comments below which one surprised you the most. And if this helped you at all, please subscribe to the channel. This is a brand new channel where I'm making financial planning content just like this as a CFP with 15 years of experience to help people just like you. That's it for today. Thank you so much for watching. I really appreciate your time. I'll see you on the next video.